Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Wednesday, May 27th, 2026, and we're seeing some notable shifts in market sentiment as institutional money rotates and valuation concerns bubble up. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. The dominant story right now is this growing tension between AI optimism driving markets higher and serious warnings about excessive valuations. We've got stocks extending to new highs on AI momentum, with TSMC's CEO pledging more than 30% incentive bumps as their AI profits soar. But here's the counterpoint that's creating unease. Jamie Dimon just came out warning that markets have too much exuberance, and he's joining voices like Michael Burry who are seeing a looming correction. Goldman Sachs just lifted their S&P 500 target to 8,000 based on earnings strength. But at the same time, we're seeing strategists recommend soaring bond yields as protection against an AI bubble. That's a pretty clear signal that even the bulls are hedging their bets. The other major development is geopolitical, with stock futures rising during US-Iran talks. The ECB actually warned that Trump risks triggering a financial crisis if there's war with Iran. And the market isn't fully pricing in a peace deal, which could provide a significant lift to European stocks if tensions ease.
That's quite a contradiction. Bullish price targets alongside bubble protection strategies. What does this mean for traders and investors navigating these mixed signals?
It means selectivity is absolutely critical right now. The chip rally continues to roll on. We're seeing companies in the semiconductor space posting strong gains. And there's this interesting development where an Idaho chipmaker doubled to $1 trillion in just 48 days. But you've got to be careful because we're also seeing data that 99% of CEOs plan AI layoffs within the next 2 years, with entry-level workers facing the biggest impact. That's going to affect consumer spending and corporate margins down the line. On the technical side for the major indices, the S&P 100 is testing resistance at these elevated levels, and we need to see continued earnings support to justify the valuation. The Nasdaq is showing strength, but it's heavily concentrated in AI and chip stocks, so there's sector risk if that narrative shifts. The Dow is actually lagging a bit, which tells you that traditional industrials and financials aren't participating as strongly in this rally. From a trading perspective, I'd be looking at taking some profits on extended positions and rotating into sectors that could benefit from geopolitical de-escalation, particularly European exposure if this Iran peace deal materializes.
You mentioned sector rotation. Are you seeing any specific opportunities in areas outside the AI trade?
Absolutely. Ford stock is surging. And interestingly, it's got nothing to do with their car business. We're also seeing SpaceX building toward what could be a major IPO, and their rocket monopoly is giving them an edge over OpenAI in the IPO race. The energy sector is worth watching too, because oil has been sliding, which typically benefits consumer discretionary stocks and transportation companies. UK household energy bills are set to rise 13% from July to a 2-year high. So there's regional divergence in energy costs that creates trading opportunities. I'm also keeping an eye on the software sector because there's talk of a new bull market in software stocks, though that hinges on upcoming earnings reports. The key is not chasing the momentum plays that are already extended, but looking for quality names that have been overlooked in the AI frenzy. Bond yields rising actually makes dividend-paying stocks and utilities and consumer staples more attractive on a relative basis, especially if you believe we're near a correction. It's about building positions that can weather volatility while still participating in upside if the rally continues.
That selectivity is going to be key, especially with these valuation concerns. Steve, let's get into the economic numbers. What's the picture looking like from the data perspective?
Thanks, Robert. We're in an interesting spot economically because the data is sending mixed signals that align with what we're seeing in market sentiment. Goldman Sachs just put out analysis showing that inflation pressures are intensifying across Asia-Pacific economies, which is significant because that region has been a manufacturing and export powerhouse. When you see inflation building there, it typically flows through to global supply chains and eventually hits consumer prices in developed markets. The ECB is taking weaker growth into consideration according to Vice President Guindos, which suggests European policymakers are worried about the growth-inflation trade-off. They're dealing with the potential for stagflation if energy prices stay elevated and growth slows simultaneously. Republicans are staring down an inflation abyss with midterms fast approaching, which tells you that inflation remains politically sensitive and could influence fiscal policy decisions. On the housing front, mortgage refinance demand dropped 18% as rates hit the highest level since August, which is a clear indicator that higher yields are starting to bite into consumer activity. This matters because housing has been one of the more resilient sectors, and if that weakens, it has knock-on effects for construction, retail, and financial services. We don't have major releases today, but the data we're getting from corporate earnings and regional indicators suggests the economy is still growing but at a decelerating pace, and inflation hasn't been fully conquered despite what some of the headline numbers might suggest.
Those housing numbers are particularly concerning, given how important that sector is to overall economic health. How should we interpret the inflation pressures you mentioned in Asia-Pacific?
The Asia-Pacific inflation dynamic is really important because it's a leading indicator for global price pressures. When manufacturing costs rise in countries like China, Vietnam, and Thailand, companies have two choices: absorb the costs and compress margins or pass them through to consumers. We're seeing evidence of both happening right now. The fact that Goldman is highlighting this intensification suggests it's broad-based rather than isolated to one or two countries. This comes at a time when central banks in developed markets were hoping to see inflation continue moderating, allowing them to maintain accommodative policy or even cut rates further. If imported inflation picks up from Asia, it complicates that calculus significantly. The ECB's consideration of weaker growth alongside these inflation pressures shows they're worried about being caught between needing to support growth and needing to contain prices. For the US, we've got the added complexity of potential tariff policies and trade negotiations that could either amplify or dampen these imported price pressures. The mortgage data I mentioned is particularly telling because it shows that even without the Fed hiking rates further, the market-driven increase in yields is already tightening financial conditions that's effectively doing the Fed's work for them, but it also increases recession risk if it goes too far. The next few weeks of data will be critical in determining whether we're seeing a soft landing or something more problematic.
Now let's turn to crypto markets. Lizzie, what are the latest trends you're seeing in digital assets?
The crypto market is showing some serious weakness right now, and it's largely being driven by institutional rotation out of digital assets and into AI stocks and precious metals. Bitcoin sentiment is cautious bearish heading into next week. We saw BTC drop from $78,000 highs, and it's currently struggling around the $75,000 support level. The big story is this $1.3 billion BlackRock ETF dark pool sale that coincided with the recent drop, which shows large institutional holders are taking profits. There's mixed activity among treasury companies, with Strive adding 1,109 BTC to bring their total to 16,500 coins. But other firms like Strategy have paused buying. Technical analysis shows Bitcoin broke its 3-month uptrend versus gold, and there are bear market signals resurfacing. For next week, I'm looking at a bearish to neutral outlook with downside targets of 70 to 72,000 if that 75,000 support breaks, and resistance up at 78 to 80,000. Ethereum is in worse shape, frankly. David Hoffman from Bankless just sold his ETH holdings despite staying long-term bullish, which is a significant sentiment indicator. Total value locked in DeFi hit 13-month lows, and the price chart is targeting $1,800. The sentiment there is bearish with downside to the 22 to 2300 range, and you'd need to clear 2500 to confirm any recovery. Solana is more neutral, following the broader market with development on privacy layers, targeting token unlocks, but it's got less institutional selling pressure than BTC and ETH.
Those are some significant moves, particularly that BlackRock dark pool sale. What's driving this institutional rotation away from crypto?
It's really about opportunity cost and risk management. Institutional investors are looking at the returns in AI-related stocks and semiconductor companies, and they're seeing more predictable cash flows and earnings growth there compared to crypto's volatility. Bitcoin dropped to 13th largest asset as capital fled to AI and precious metals, which tells you where the smart money is rotating. The other factor is that traders are preferring dollars over Bitcoin right now, with USDT and USDC dominance rising, which indicates a flight to stability within the crypto ecosystem itself. On the institutional side, while retail might panic sell, we're seeing sophisticated players like Strive and some treasury firms actually accumulating below cost basis, which they view as value investing. The Bitcoin mining stocks got a boost from the AI infrastructure boom narrative, which is interesting because it connects crypto to the AI theme. But overall, the technical picture is concerning, with liquidation hunts controlling BTC around 77,000 and whale movements creating volatility for Ethereum. Specifically, the fact that treasury firms are leaning more on staking as ETF pressure builds shows they're adapting to lower price expectations. Next week is going to be critical, because if Bitcoin can't hold 75,000 and Ethereum breaks below 2,200, we could see a deeper correction that tests whether this is just profit-taking or the start of a broader bear phase.
That wraps up today's Morning Bell. We've covered a lot of ground, from market exuberance warnings to crypto weakness and mixed economic signals. The key takeaway is that while momentum remains strong in certain sectors, particularly AI and semiconductors, there are growing concerns about valuations and institutional positioning that warrant careful attention. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to the Morning Bell and join us tomorrow as we continue tracking these developing stories. I'm Robert. Thanks for listening.